Well, hello, welcome to Passive Wealth for High Tech Minds podcast. There are lots and lots of IT professionals who work in the industry. These IT jobs are so exhausting mentally, there isn't much time left for such folks to make clever decisions about their investments. Most are unable to put their money in the right asset classes. This is Prashant Kumar from iRealty Gains. I have worked in corporate America in IT and in business organizations for 25 years. My goal is to educate IT professionals like you about the benefits of passive investing. I will be passing my knowledge and will bring guests who have done very well in their careers and can explain the process and advantages of passive investing. So, let's begin. Well, hello. This is Prashant Kumar from iRealty Gains. We are in yet another podcast for Passive Wealth for High Tech Minds. Today, we are going to talk about market cycles, real estate market cycles. I'm going to start sharing my screen and then we will go further. So if you look at this slide, basically, we have a bell curve here. And, this is the real estate market are in a bell curve shape. We always start down here in the recovery portion. Think of 2008 at the bottom of phase one, right? And around 2010, we were 2 points higher. As we started to grow our markets, we came up to where most markets are in 2021 at equilibrium, or just 1 point before that or after. In phase one, we are in recovery. We just come out of recession. And now we are starting to recover. So as our NOI, you can see this is the vertical line. Our income or our NOI grows. We start to get reduced vacancies or occupancies increase. We are now getting more demand for apartments. As we get more demand for apartments, our vacancies start to absorb. We will start to see the rent growth. As the rent grow, the NOI start to grow as the occupancy gets above the long-term occupancy average of the market. The NOI continues to come up because as more units are filled, demand and supply says that when we have more demand than you have supply, the rent will grow. So as the rents grow and the NOI comes up, we get to a point in the market where we can afford new developments. Now we are in phase two, the expansion phase. When a market gets above the long-term occupancy average and is one on the left side of equilibrium, it is considered to be in the expansion phase. New construction starts here because now developers see that there is enough meat on the bone, that they can make some money and build apartment complexes. As they build, rents are still climbing because they are not delivering yet. So the market starts to accelerate pretty quickly. Then you start to see some deliveries at the next point in phase two. As the units are being delivered, rents are starting to level off because more units are being put in the market. There is absorption taking place at a faster pace now. So as deliveries are happening, units are being filled and managers start to create concessions because they are trying to fill these units. You will start to see the rents start to level off a little bit. And as rents level and the absorption slows down, the market gets to that point of equilibrium where demand and supply are equal. Nobody has ever been able to pinpoint when that point occurs. We can pinpoint equilibrium after it occurred and identify points before it occurs. For the circle between 2008 and 2022, I can tell you that in the United States, we passed equilibrium in the apartment market around Valentine's Day of 2022. As we start to go into phase three, oversupply, absorption is no longer keeping up with the deliveries and rents are slowing down. Rents may still be positive, but you start to see some weakness as units continue to deliver. And because builders did not recognize equilibrium, now the market cannot keep up with the absorption. The rents start to decrease, people start moving out, causing higher vacancy, and we go into phase 4 recession as the market drops below the long-term occupancy average. This is the shortest phase of the cycle, and like equilibrium, it is very difficult to predict the bottom. The timing from recovery to equilibrium is the long-term part of the bell curve, and then term is much more shorter from equilibrium to the bottom of the recession. It is kind of like trying to climb a mountain and then going down as a slide. So if this image was drawn more to scale, there would be much shallower part of the bell curve to a very steep part of the bell curve on the other side of the equilibrium, because we tend to grow through oversupply and recession fairly fast. These are 4 different cycles. One is recovery, second is expansion, third is oversupply, and fourth is a recession. We have our long-term occupancy average line. We have our NOI line, our point of equilibrium, and our point of new development. If you see the chart given by Dr. Mueller with the University of Denver puts out a market cycle chart every quarter. You can see that in phase 3 hypersupply, he has about 1/3 of the markets and equilibrium in 2/3 of the markets. What do each phases of cycle mean? One is transition phase, which is recovery. In recovery phase 1, we are in transition phase. This is the period of reinvention. This is where we start to put together a new business model, because we had before broke, and we start to diversify our risk. We have renewed customer focus, so back to focusing on tenants and the investors, because we kind of lost focus on them as we were in euphoria and got a little complacent. Cash is king in the recovery phase. We have got to focus on fundamentals, and consolidation continues to accelerate, meaning people are folding up boxes, selling their non-core assets. They are getting rid of their troubled properties, because this is also where people are purchasing those assets that are getting old. So what is the solution? We need to build a pipeline so that we constantly have opportunities coming in. Again, we have consolidation accelerating, so we may be able to capitalize on some of that consolidation. A rebranding takes place. If you were an owner during this period, because you probably went through some pretty tough times during the life cycle, down cycle, and now you want rebrand so that you can reposition your assets. You accelerate value add acquisitions. We talked about consolidation accelerating here. This is where the buyers are accelerating and initiate development at some point, but not yet. So let's talk about growth phase. In growth phase, we got into expansion phase. We will start to initiate new development, right? We expand offerings and reposition assets, basically, that end up having a tough time during the downfall. This is the period of opportunity. The market has rising occupancy levels, rising rents, and growth in NOI, and with an increase in asset value, development activities is now occurring in most markets. Capital is available and new competition start to hit the market. So what's the solution here? Start to expand vertically. If you are just purchasing value add assets for conventional apartments, maybe now you expand into property management or expand into development or adaptive reuse, where you buy a hotel and turn it into multifamily property. You expand geographically. If you have only been investing in your market, expand into other markets. If you have only been investing in Southeast, you need to expand further. Start expanding into Midwest or maybe Southwest, depending upon where some of the growth is occurring. Expand your customer base, and instead of just going after conventional apartments, going to student housing, senior living, or low income. You can also invest in infrastructure and expand adjacencies, which are the properties next to you. If you expand into adjacencies, it just means that you are expanding that property by purchasing the land around you if it is available. And then, of course, you leverage your capital at that point, basically. So let's go into next phase, which is plateau phase. The plateau phase is oversupply phase. Some periods of decisions start to happen here. You start to see demand supply imbalance. You will see a lot of optimistic underwriting and some unrealistic asset values and generous tenant improvements. A TI is a commercial world, would be tenant improvement. You will see a lot of units rehab happening, which could be considered as same thing. People are starting to get a little loosey-goosey with the amount of innovation they are doing. Rent concessions are starting to happen, and this is a period of high investment activity. What are your solutions here? You need to dispose of non-core assets if it is not your core market. I know an owner that owns all his properties in Georgia except one. He owns one property in Alabama. It's the time to dispose of that non-core asset. His expertise, team, and all other properties are in Georgia, not in Alabama. So he should dispose of that one non-core asset. Locking into long-term debt. If you are buying in the plateau phase, the short-term that you are setting yourself up for failure. You need to be able to make it through the down cycle, not knowing how long down cycle is going to be. So if you don't want to be stuck short-term financing, better come out of that. For brokers, you need to build their third-party work. It just means that provide market analysis to people, become a consultant, because transactions are going to be few and far in between during the plateau phase. So let's see. I mean, we will talk about next phase now, but before that, start to accumulate cash, start building relationships, and basically, cash is the king. Start to build relationship with other investors and let them know what you are doing in the market, right? So, and basically, what are your plans? Let them know what you are doing in the market. What are your plans? What your plan is for when it hits the bottom of the phase, and where you are going to start to attack. And of course, downsize your non-core assets. So let's go into crisis phase. In the crisis phase, this is recession phase 4. This is the period of change. Rents are now declining there. There's little development to no development going on, and limited access to credit, which means bank stop all credit facilities. You can still get private credit through life insurance companies. Life insurance companies will invest. So you need to have other credit facilities that you can go after, but they are going to become far and few in between as you start deleveraging, because if you are over leveraged, you are in bad shape. The asset values are declining. At this point, lenders are doing workouts and restructuring, and entities are downsizing. So what is the solution? The solution, here is acquire underperforming assets. Notice you are in worst part of the cycle, so buy. To acquire underperforming assets, acquire necessity real estate, and acquire market share, customer base, and talent. That's all for today. Thank you so much for joining. Once again, this is Prashant Kumar from My Realty Gains. We are talking in Passive Wealth for High Tech Mind podcast today. Thank you so much for listening to our podcast. As usual, you can reach me via my website, www.myrealtygains.com, and via email, prashant@myrealtygains.com. I would love to hear from you and talk to you about specific needs you may have. Please schedule an appointment with me via my website, again, www.myrealtygains.com. Stay tuned for next podcast. This is Prashant Kumar signing off for today.